Oh, it's just that simple. It's just that simple. Let me ask you this. What's the difference between you and this guy, or this guy? And no, it's not a luxury yacht, private jet, or $1 billion in the bank. That would have been the easy answer. The difference between you and say someone like Warren Buffett is that Warren likely pays a lower tax rate than you. No duh. These guys have like a whole army of financial advisors, tax attorneys, CPAs in their family offices that have decades of experience avoiding taxes. Okay, you have a point there, but what if I told you the easiest way to avoid taxes is actually as simple as 3 steps? And honestly, you and we could do it in a couple of mouse clicks. Still not convinced? Well, stick around in this video because I'm gonna show you exactly how the ultra wealthy avoid taxes and how you can do the exact same. What's going on, folks, and welcome back to the channel. My name is John, and in this video, I'm handing you the keys to the kingdom. I've done the research and I'm providing you what's arguably one of the easiest and most effective tax avoidance strategies known to man or woman. It's known as buy, borrow, die. Okay, so step 3 isn't the most user-friendly, but 1 and 2 certainly are, and not only that, they could potentially reduce your taxable income down to bing. So if this sounds like a plan, make sure to tap that thumb icon, subscribe if you like, and we'll dive right in. Quick disclaimer, none of what I'm about to provide for you is tax, legal, or financial advice. I am just a guy on YouTube who Googles really well. If you're going to take action or if you have in-depth questions, please consult a licensed professional. I would be remiss in making this video about tax minimization strategies and not address a glaring issue we face around the globe, and that is wealth inequality. The top 10% of families in the United States now control over 70% of the wealth pie. The bottom 50% of families control about 1%. That to me is absolutely mind-blowing. That just doesn't seem right on its surface. So as we go through this video, don't just focus on how do I cut my tax rate to 0, because I'll show you exactly how, but really think about how the game is played. My purposes are here to provide you the rules the top 10% are playing with so that when it's our turn at bat, we know exactly what to do. The buy, borrow, die method has one objective and one objective only: avoid income taxes. And quite honestly, once we walk through it, you'll see just almost how embarrassingly simple it is, yet a lot of folks have no idea how to leverage this. Here's a fun fact when it comes to income taxes. It wasn't until 1913 that the 16th Amendment was ratified in the United States. The 16th Amendment gave Congress the right to implement a federal income tax. So if you were born before 1913, you had the privilege of paying no federal income tax. But you also didn't have access to things like YouTube, where you could tap that thumb icon on my video. Step 1, buy. Buy appreciating assets. For example, land, art, and my personal favorite, growth stocks. In order to be taxed on your income has to be taxable. Let me explain. The gains on an appreciating asset typically are unrealized, and unrealized gains are not taxable. Now, you and I might think not taxing unrealized gains is a bit of a no-brainer, but that wasn't always the case. In fact, in 1920, that's when it became established, known as the realization requirement. And in the 1920 Supreme Court case, Esner versus Macomber, Myrtle Macomber received pro-rated stock dividends from Standard Oil. She had 2,000 shares, and Standard Oil issued her another 1,000. They're not the dividend we see today where it's a cash payment, but these dividends were in the form of stocks. And the argument was, because they were stocks and there was no realization of those gains, it wouldn't be taxed. The court went ahead and ruled in her favor, and that's where we got the realization requirement from. So if you have assets that appreciate but you never sell, you will not be taxed on that appreciated asset. Another point to drive home the value of assets is stated by none other than Mr. Robert Kiyosaki, the famous author of the book Rich Dad, Poor Dad. In this example, we imagine having $100. You take your $100 and you put it into a savings account that accrues 5% interest. The $100 you put in is from post-tax money. In addition, that interest account that you put it in is paying you 5%, but that 5% is being taxed. In effect, you're kind of being double taxed. Whereas if you took the $100 and bought, say, a growth stock and it appreciated over time, that appreciation would be an unrealized gain and it would not be subject to tax. You're next probably wondering, well, what if I wanted to get my $100 out? How would I do that? Great question. Step 2, borrow. Having all of this money put away, not taxed on, seeing your portfolio slowly climb to the moon is fun and all, but sometimes I want a taste of my attendees. So what would I do? Well, I'm smart enough to know if I sell my portfolio, immediately that's a realized gain. And as soon as that gain is realized, I'm handed a tax bill. So I go and get a loan against my portfolio, meaning my portfolio acts as collateral. This is known as a securities-backed line of credit, or also a pledged asset loan. Let me contrast this to a margin loan, which a lot of you might be familiar with because a lot of you may have gotten burned in the past with them. When it comes to a margin loan, the requirements to meet whatever that minimum is are a little bit tighter, and sometimes the time length to meet them are tighter. If your portfolio were to dip by 10 or 15% in a margin loan type of situation, you may be subject to a margin call in which you have a very short amount of time to meet up whatever the margin loan requirements were. In contrast, a securities-backed line of credit, you typically would have anywhere from 2 to 3 days to meet that lending requirement. You can either pay back the loan you took out or pledge more collateral to make up the difference. In addition, a securities-backed line of credit is a non-purpose loan, meaning you cannot use it to buy securities. Whereas with margin loans, they're typically used to buy securities. But an SBLOC can pretty much be used to buy anything else. House, car, boat, plane, train. Hey, you're a wealthy individual, you're using advanced tax acts, you can buy it. The most common SBLOC product I found on the marketplace for everyday retail investors would be from Charles Schwab, known as a pledged asset line. Typically, the more you pledge, the lower the interest rate of the loan. And here is why this works. In a 1955 Supreme Court ruling of Glenshaw Glass versus Commissioner, basically establishing borrowed money is not considered income. So any loan you take out is not taxed. But surely you have to pay tax at some point? Step 3, die. The third and final act is to go 6 feet under. And here is kind of where the magic happens. You spent your entire life avoiding to pay any taxes on the capital gains of your appreciated assets. And at death, you get the privilege of passing off all of those assets to your heirs tax-free. They pay nothing. Here's why it works. When you die and pass off your assets to your heirs, they receive it at a stepped-up basis. Under a stepped-up basis, the heirs receive the assets income tax free under IRC section 102, and with a basis equal to the fair market value of the assets at time of death under IRC section 1012, meaning now your kids can take your assets, sell whatever is necessary to pay back any debt, and the circle begins anew. Simple, right? Buy, borrow, and die. The two most common objections I saw were people wondering, well, why would they pay interest to borrow money that they already have invested? And number two, what happens when there is some sort of maintenance call or margin call on their total pledge collateral? We're gonna go ahead and walk through an example to address both of those issues now. For simplicity's sake, we will assume the cost basis is 0 and the portfolio value is $1 million each. Let's take a look at John and Viv. John and Viv have worked so hard to grow their portfolio to $1 million. And now it's time for a long sought after vacation. John, though, being impatient and having no strategy, immediately sells his $1 million portfolio and pays 40% in tax and takes the rest. So he would have paid $400,000 in tax to then be able to spend $600,000 on the dream vacation of his choice. He is now left with a portfolio balance of 0. Viv, on the other hand, is much smarter than John, and she knows she doesn't have to sell anything. She can just go ahead and get a loan. So she goes to Charles Schwab and she gets a pledged asset line of credit for the value of $600,000. Immediately you see now, Viv already has $400,000 more than John simply because she did not sell. Now, an objection typically arises discussing the interest rate. John, on one hand, has all cold hard cash. He doesn't owe anyone anything. Viv, on the other hand, has a $600,000 loan and she has to pay interest on it. According to the pledge asset line, she would owe an interest rate of about 2.95%. So there's no way that she comes out ahead. Well, remember, John has no more appreciating assets. Viv has $1 million that's appreciating. If we assume that it appreciates at the market rate, which is about 10%, then simplistically, each year, that $1 million will give her $100,000 of appreciation. The interest that she bears on this account is about 2.95%. So 2.95% interest on a $600,000 loan, she will owe about $17,700. And the difference between $100,000 and $17,700 is $82,300 of appreciation. You can see, because John has no more assets appreciating, he's getting nothing every year. And even though Viv has a loan in her name, because she still has $1 million in her portfolio that's working for her and appreciating, she's coming out net positive $82,300 every year. The second fallacy we typically encounter is, well, what happens when the portfolio value dips? Viv would be in trouble. Yes, she would be in trouble, but there are certainly ways to mitigate that. For one, typically folks who are using this method are extremely wealthy. So for them, they can always shift assets around to be able to cover on any sort of maintenance call. The second thing is you can also just put in a stop loss. If Viv's portfolio were to ever dip below $1 million and she had to sell or cover, she could immediately sell everything, be taxed $400,000 the same way John was, take the $600,000, pay back her loan, and she would be in the exact same position as John. But if their portfolio ever ends in a future state greater than $1 million, then mathematically, Viv will always come out ahead by taking out that loan. And of course, the last step, when they both pass away, John might not be able to leave much, whereas Viv can leave an appreciated asset at a stepped up basis to her heirs who can then repeat the cycle. Wow, what an incredible video and an incredible concept. As a reminder, step 1, buy appreciating assets. Step 2, take loans out against your assets. Step 3, when you pass away, you can pass off those assets at a stepped up cost basis to your heirs and they can continue the cycle again. And really, I guess they could continue it indefinitely, which is crazy. So if you want to talk about minimizing your tax burden, that's exactly how you get away with paying $0 in taxable income. Or I guess it's not technically income, $0 in just taxable spend. Appreciate everyone for tuning in. My name is John, and I will catch y'all next time. Peace.